Ever wondered who actually controls the money in your country? That's where central banks come in. A central bank is an institution that manages a nation's currency, money supply, and interest rates. It's like the bank of banks. It doesn't deal with the public directly, but its decisions affect everything from your savings account to the price of groceries. Some well-known central banks include the Federal Reserve in the United States, the European Central Bank, ECB, and the Bank of England. Most central banks are independent from political influence, though they work closely with governments. So what exactly do they do? 1. Controlling inflation. One of the central bank's main jobs is to keep inflation under control. They usually aim for a steady inflation rate around 2%. If inflation gets too high, prices rise too fast. If it's too low, or negative, it can lead to economic slowdown. 2. Setting interest rates. Central banks control the base interest rate. When they raise rates, borrowing becomes more expensive, which slows down spending and cools inflation. When they lower rates, borrowing is cheaper, which encourages spending and investment. 3. Managing money supply. They control how much money is circulating in the economy. If the economy is slowing down, they might inject money by buying government bonds. If the economy is overheating, they can reduce the money supply to avoid inflation. 4. Acting as lender of last resort. During financial crises, central banks provide emergency loans to commercial banks to keep the system stable. This is what happened during the 2008 global financial crisis. 5. Stabilizing the financial system. They regulate and supervise banks to make sure the financial system stays healthy. They want to prevent bank failures, maintain trust in the banking system, and avoid panic. Let's use a simple example. Imagine the economy is overheating. People are spending like crazy, prices are rising, and inflation is getting out of hand. The central bank steps in and raises interest rates. Now, loans cost more, so people and businesses borrow and spend less. This helps cool down the economy and brings inflation under control. On the other hand, if there's a recession and people aren't spending, the central bank might cut interest rates or even print more money to encourage economic activity. Central banks walk a tightrope. They don't want the economy to grow too fast or too slow. Their policies shape everything from mortgage rates to job growth. And in today's world, central banks are also experimenting with digital currencies, which could change how money works in the future. So in short, central banks manage inflation, interest rates, and money supply. They stabilize the economy during crises. Their decisions affect your loans, savings, and job market. Thank you for watching. If you liked this video, please click like and subscribe to the channel for more quick and clear explanations about the economy, investing, and crypto. See you in the next one.